You're doom scrolling through Zillow at 2 in the morning, and every house that doesn't look like it needs an exorcist costs $500,000. The kitchen has countertops from when dial-up internet was still a thing. 500,000 for something the listing agent confidently calls a starter home, complete with outdated countertops, worn carpet, and a basement that never recovered from the 70s. Meanwhile, you're running mental math on your phone, wondering if you somehow missed becoming a tech executive. Here's the truth nobody wants to say out loud. It's not you, it's the math, and the math is brutal. What makes this so frustrating is that most people assume they're doing something wrong. They think they waited too long, picked the wrong career, didn't hustle hard enough, or missed some obvious step everyone else figured out. And when you feel like you're failing at something as basic as housing, it hits deeper than money. It feels personal. But this isn't a personal failure, it's a structural one. The numbers have shifted quietly over the last decade, and most people are still using rules that no longer apply. So before we talk about what anyone should do, we need to look at what's actually happening. Without shame, without panic, just the math. Today, we're figuring out who can actually afford a $500,000 house in 2026. Not who can get approved for a loan, not who can sign paperwork, but who can afford it without turning their life into a constant financial stress test. Because there's a massive difference between qualifying for a mortgage and actually sleeping at night once you own the house. In many American housing markets right now, $500,000 isn't luxury money. It's baseline. It doesn't buy you a dream home. It buys you a modest house in a decent area. And that's where the problem starts. The median household income in the United States is about $84,000 a year. That means families earning $84,000 are expected to buy homes costing 6 times their annual income. Historically, 3 times income was healthy. 4 times was aggressive. 6 times isn't ambition. It's financial risk that's been normalized. Somehow we all collectively agreed this was fine. No meeting, no vote. Just vibes and mortgage calculators. For decades, housing followed a fairly stable relationship with income. Prices went up, incomes went up, and while there were cycles, the ratio stayed within a range that allowed most households to breathe. A mortgage was a commitment, not a constant source of anxiety. What's different now isn't just prices, it's speed. Home values surged far faster than wages, and the gap never closed. So when older generations talk about how they made it work, they're often talking about a completely different math problem. Same word, house, but a totally different equation. That disconnect is why so many people feel like they're falling behind, even while doing everything right. Everyone insists it's doable. Mortgage brokers approve you. Parents remind you they bought their house for far less. Social media makes it look effortless. But almost everyone is lying about what affordable actually means. Let's start with the down payment. Traditional advice says 20%. On a $500,000 house, that's $100,000 in cash. The median savings balance in America is around $8,000. Most households aren't close, they're tens of thousands of dollars away. Even saving 10% of income, it would take more than a decade to reach that down payment, assuming prices stopped rising. They don't. So most buyers put down less and accept PMI, an extra $200 to $400 a month that protects the bank, not you. Now the monthly cost. With 10% down, the mortgage alone lands around $2,700 to $2,800. Add property taxes, insurance, maintenance, and PMI, and the real monthly cost lands around $4,300. That's before repairs, HOA fees, or upgrades. And this is the part that rarely shows up in affordability calculators. Houses don't just sit there costing the same amount every month. Roofs age. HVAC systems fail. Water heaters quit at the worst possible time. Even in a good year, maintenance quietly eats a few $1,000s. When your housing cost already consumes most of your financial bandwidth, those expenses don't feel like inconveniences. They feel like emergencies. You delay fixes, you hope nothing else breaks, and you start making decisions based on fear instead of logic. This is how people end up technically homeowners but financially frozen. They can't save. They can't invest. They can't take risks or make changes because the house has claimed all the margin in their life. Financial guidelines say housing shouldn't exceed 28% of gross income. Reverse the math. To afford $4,300 responsibly, you need to earn about $187,000 a year. Even using looser bank standards, you still need around $150,000. Only a small percentage of households earn that much, which means for most Americans, a $500,000 house is not realistically affordable. That's not opinion, it's arithmetic. So, who's buying these homes? Dual income professionals, people with family help, those who bought earlier, and many households stretching themselves one emergency away from collapse. Take a household earning $160,000 a year. After taxes, they take home about $9,500 a month. Subtract housing costs, and they're left with roughly $5,000 for everything else: cars, insurance, groceries, student loans, utilities, life. There's very little room left for savings or emergencies. That's nearly half their take-home pay going to housing. Not because they're irresponsible, but because this is what the market now calls normal. And this is what being house poor actually feels like: constantly checking your bank balance, delaying repairs, stressing over every unexpected expense, one broken system away from using credit cards just to stay afloat. What makes this worse is that nobody involved is incentivized to warn you. Sellers want top dollar. Banks want loans that won't default immediately. Agents want deals to close. The system is designed to get you into the house, not to make sure you can afford it long term. Here's the uncomfortable truth. For most households, a $500,000 home is not affordable without sacrificing stability and peace of mind. This isn't about skipping lattes or working harder. Home prices have grown far faster than incomes, and the math no longer works. You don't have to play this game. You can run the real numbers and walk away. You can rent, save, invest, move, or wait. Real wealth isn't owning a house you can barely afford. It's having margin, options, the ability to sleep at night without financial anxiety. The smartest move isn't buying the biggest house the bank will approve you for. It's choosing a payment that lets you live without constant fear. And for most people, that number is nowhere near $500,000. Sometimes the smartest decision is recognizing when the game is rigged and choosing not to play. And if this feels discouraging, it shouldn't. You're not behind. You're not bad with money. You're operating inside a system that changed faster than the advice did. Once you understand the rules, you can make decisions that actually work for your life without shame or panic. If this kind of grounded money thinking resonates with you, subscribe. This channel is about financial clarity in a system that rarely offers it.